In this video, I'm going to talk a little bit about what I'm calling phase three of the stock market cycle or and business cycle. So let me kind of refresh your memory just a little bit here. So phase three is kind of this main chunk of the expansion kind of period here. So we're in part of the expansion, but kind of we have lots of economic growth. We're after the trough, things like that. Okay. So basically what's going on in phase three, we got strong growth of the economy. Everything's looking great from that standpoint. Somewhere in the middle of phase three, interest rates are going to start to go up because inflation is start to go up. So basically, inflation is too much money chasing too few goods. And so as the economy grows and expands, generally the Federal Reserve previously, when it lowered rates, basically what that meant is they pushed a bunch of money into the system. And so when they pushed a bunch of money into the economy, eventually that money starts chasing goods and we start getting inflation. And so as the inflation starts to tick upward, the Federal Reserve starts raising rates. They're pulling the money back out of the system. And eventually, by kind of late in that economic expansion, so sort of late phase three, somewhere in there, the stock market will typically peak. All right. And if you kind of go back to things that I talked about in a prior video, the bond market would actually peak somewhere in phase three as well, but before the stock market typically. Because once that inflation starts to go up, the interest rates start to go up. When the interest rates start to go up, the bond market typically peaks. And then sometime after that, the slowing economy and the pressure from the increased interest rates eventually catches up with stocks, and the stock market typically peaks, after the bond market does. So let's talk about companies that typically do well in this phase. So basically, kind of there's a little bit of logic here. So the idea is, if you think about, get back to phase two, with phase two, the consumer is back, he's buying houses and cars and furniture and, all these kinds of things. But that also means that we're now going to have some follow-on demand from that, right? So companies are going to be running more at full capacity, trying to build capacity in factories and facilities and things like that. And so as a result, basically you're going to have a fair amount of demand in phase three for construction and expansion companies. So whether it's building materials, like produced building materials, electrical components, factory equipment, heavy constructions, kind of things, heavy machinery, industrial and commercial services, pollution waste management, on and on. So basically, the businesses are growing and expanding, and they're building more capacity to kind of catch up with all the demand that has been unleashed in phase two. And that brings up the important point here that it's not like the phase two companies just suddenly just stop doing well in phase three. They're generally going to be doing pretty well in phase three as well, because the consumer is feeling pretty good. They're feeling pretty optimistic about the economy and so forth. But these are companies that are going to kind of roll into also doing well because of the fact that when the consumer started buying all that stuff, the companies then needed to produce more or get more capacity in order to produce more and so forth. And so they start building and expanding and things like that, basically. You also see typically transportation tends to do well. It's containers and packaging, railroads, trucking, marine equipment. I mean, basically, if the economy is roaring along, and as the economy is roaring along, we're shipping more stuff around from point A to point B. Consumers are buying more stuff. Businesses are shipping things to other businesses. A lot more economic activity there, and so transportation is going to do better. The construction is going to be happening because we're going to be expanding and building and so forth. And so what's really kind of driving this phase is ongoing expansion in the economy, and ultimately companies kind of hit that capacity, or they're operating near capacity, so they're trying to build more capacity to sell more products or services and what have you. Now, for the yield curve, early on in phase three, the yield curve is pretty normal. But somewhere through kind of the middle part of phase three, as the inflation starts to come back into the picture, the Federal Reserve starts raising rates to combat inflation. And so when that happens, basically that yield curve is going to become a little bit less normal shaped. In other words, the short-term rates are going to be creeping up. And as the short-term rates creep up, there's going to be a little bit less of that normal shape to it. And so from that standpoint, as you kind of progress through phase three, it'll be a little bit less normally shaped as you go through that. And in terms of general economic conditions, basically, if you think about this, economy is growing well, unemployment is going down because all this economic growth. Interest rates were low to start with. They start creeping up a little bit later on in kind of mid-phase three and a little bit later, basically because of inflation. So inflation was low to start with, but then inflation started to creep back up. And so as a result of inflation creeping back up, those interest rates started to creep up as well. And then kind of somewhere in middle phase three, somewhere in there, when the interest rates start going up because of the inflation was going up, that's when the bond market's typically going to start to have a peak and kind of start to head down a little bit. And then somewhere kind of later in phase three, after those elevated interest rates have kind of caught up with the stock market and they've kind of depressed economic growth and things like that. Generally, that's when the stock market is going to peak out somewhere kind of more like late phase three. The economy is still sort of doing okay, but probably growth is slowed. And because of the higher interest rates, with the slower expectations of growth, eventually, basically, the prospects just don't look as good for the equities, and basically, stock market starts to go down, even though the economy is technically still growing at that point. All right, hopefully, this little discussion of phase three has been helpful. Thank you so much for watching, and have a great day.